For years, we've been told that the American economy is strong. GDP is expanding. The stock market is near record highs. Corporate earnings are solid. Unemployment remains relatively low. On paper, it looks like resilience, prosperity, stability. But here's the uncomfortable question. What if much of that strength is surface level? What if we are living inside an economy that appears robust in financial metrics, but is structurally weaker underneath? Because there is a profound difference between a productive economy and a financialized one. A productive economy grows because businesses innovate and workers become efficient. A financialized economy grows because asset prices inflate, debt expands, and capital becomes concentrated in financial instruments rather than productive infrastructure. Those two models can look similar from 10,000 feet, but they function very differently over time. Right now, America's strength comes from financial markets rather than broad-based vitality. Equities rally. But when you look beyond asset prices, the picture is nuanced. Many households feel squeezed. Housing costs, insurance, and healthcare continue to climb. When stock indices make new highs while consumer sentiment remains fragile, that divergence matters. An economy that feels strong to investors but strained to workers creates tension. It shows up gradually, in trust, in confidence, in political polarization, and eventually in capital flows. Let's talk about a major shift: corporate financialization. Corporate America increasingly prioritizes financial optimization over productive expansion. Share buybacks have reached historic levels to boost earnings per share. From a shareholder perspective, this works. From a macro perspective, it doesn't. Buybacks don't build supply chains, raise wages, or fund breakthrough innovation. Instead, they reinforce capital concentration. At the same time, debt levels have expanded across every layer. Federal debt, corporate leverage, and consumer balances are all rising. Debt in itself is not inherently dangerous. But when it's the central driver, the system becomes sensitive to interest rates, liquidity, and inflation surprises. Now layer in corporate concentration. Entire sectors have consolidated. Technology is dominated by mega caps. Healthcare and defense are heavily concentrated. When industries consolidate, competition declines. When competition declines, pricing power increases. Consumers absorb the cost without proportional productivity gains. This shifts capitalism toward controlled concentration. When economic concentration aligns with political influence, large firms gain advantages that smaller competitors struggle to replicate. Barriers to entry rise. Innovation becomes more expensive. Success depends not only on productivity, but on access. Markets stop being competitive arenas. They become power structures. This is where the idea of a paper economy becomes relevant. A paper economy is not fake. It functions. It generates profits and produces growth. But much of that growth is financial rather than structural. It is asset-based rather than productivity-based. It is concentrated rather than broad. It thrives in environments of low interest rates and abundant liquidity, but it becomes fragile when those conditions change. We saw a glimpse of that when inflation surged. For over a decade, ultra-low interest rates allowed debt expansion to feel painless. When rates rose, the cost of leverage became visible. Balance sheets suddenly looked tight. A financialized system depends heavily on stable funding conditions. When funding costs rise, stress emerges quickly. When liquidity tightens, leverage becomes dangerous. Policy shifts cause asset prices to adjust faster than real wages, creating a feedback loop. Monetary and fiscal policy carry disproportionate weight in a late-stage financialized economy. Markets move not only on innovation, but on expectations of central bank action, rate cuts, liquidity programs, stimulus packages. This can sustain growth, but narrows the margin for error. If inflation remains elevated, policymakers cannot stimulate aggressively. If deficits widen too much, bond markets respond. And bond markets, unlike equities, are unforgiving. The longer an economy relies on asset price appreciation, the more vulnerable it becomes. None of this means collapse is imminent, but the nature of growth has shifted. When wealth accumulation is primarily tied to financial assets, inequality rises. When inequality rises, political polarization intensifies, making policy less predictable and increasing risk. It's crucial to distinguish between nominal strength and structural resilience. Nominal strength is visible in stock charts. Structural resilience is in productivity and capital formation. If productivity is accelerating and wages are rising, the system is robust. If asset prices rise while purchasing power feels stagnant, fragility builds quietly. The danger is complacency. It is mistaking financial expansion for real expansion. High valuations don't equal strong foundations. Markets can reward capital for extended periods, but the adjustment is often swift. Financialized gains can reverse faster than physical investments. A factory cannot evaporate overnight. A valuation premium can. A real supply chain takes years to build. Understanding this distinction requires clarity. The U.S. remains dynamic, but its internal architecture has changed. The question is what that strength is built on. If it is built on innovation and broad participation, it is durable. If it is built on asset inflation and leverage, it is vulnerable to shocks. This changes how you evaluate risk. It changes how you allocate capital and interpret policy and market signals. In a financialized system, markets can look calm right up until they don't. Successful investors don't chase headlines. They understand the structure beneath them. Clarity beats complacency. Understanding the architecture is the first step. Position intelligently in the world we actually live in, not the one the headlines celebrate. See you in the next deep dive.